Did you know you can legally reduce your taxes with offshore banking? Well, for the last 13 years, I've paid almost 0% in taxes, 100% legally, thanks to 3 choices: where I live, where I do business, and where and how I bank. And while you might not want to move or set up a complex structure, a lot of you can start using offshore banks to reduce your taxes, if you qualify. So in this video, I'm going to be sharing 7 offshore banking strategies to reduce taxes that are 10 times easier and faster to use than you think. Now, first things first, your taxes usually depend on your citizenship, where you live, and certain trigger events. And it's these trigger events that we're going to be focusing on, and how the right banking setup can help you avoid or defer them. But just keep in mind, this isn't tax advice. I'm just sharing what's worked for me and some of our wealthiest clients. So make sure you speak to a qualified advisor before you think about implementing these or any other strategies. All right, let's start by looking at the specific triggers that these strategies are going to address. And then I'm going to tell you 5 countries where you can find banks to help you implement these strategies. So the tax triggers that we're going to talk through include capital gains tax, withholding tax, tax on foreign sourced income, income recognition from real estate and other investments, ownership-based taxation, a little bit of corporate income tax, and we'll also touch on estate and inheritance taxes. And what's really interesting is that most people who are in the market for offshore banking, especially premier and private banking, can qualify to use these strategies. But like I said, there are a few countries that are better at helping you reduce taxes than others. So before I break down all 7 strategies for you, I'm just going to quickly share 5 countries where you can easily access these strategies for yourself. Of course, if you just want our team of experts to tell you which countries you qualify to bank in, we do have a free international banking assessment that you can fill out in the description below. Okay, so country number 1. Now, this is a personal favorite for me because it's home to seasoned bankers, strong and stable banks, sophisticated products, and it even has competent compliance teams. Plus, the banks here are very good at helping clients legally reduce their taxes through the sort of banking strategies that we're about to discuss. But it's not perfect for everyone. And even though this is one of my favorite banking hubs, I think country number 2 and country number 4 are a better fit for certain clients. Now, in case you haven't guessed, the country that I'm talking about is Switzerland. But not all Swiss banks are created equal. So don't think that every bank in Switzerland is going to open an account for you, let alone help you reduce your taxes. And for that reason, we like to focus on top-tier Swiss banks, typically with a couple $100 billion under management. And to access these banks, you should be coming in with at least 1 to 2 million, or 3 to 5 million if you're an American. But if you have crypto-sourced wealth, Swiss banks might not be the best fit, in which case this next country could work instead. Because here, you get all the benefits of Swiss private banking, plus direct custody of crypto, staking, yield services, and you can unlock the tax strategies we're about to cover as well. So if you have crypto and you want to find ways to reduce your taxes, you might want to consider banking in Liechtenstein. But unless you want to custody crypto or you have a specific reason for banking in Liechtenstein, then Switzerland can be more flexible. Now, in terms of deposits, Liechtenstein is on the same level as Switzerland. 1 million is the minimum, though if you want to bank shoulder to shoulder with the royal family, you should really be coming in between 3 and 5 million. And when it comes to Europe, these sorts of deposits, it's what you should expect. But if you don't want to deposit $1 million, don't worry, country number 4 is a low deposit option that still ticks a lot of the boxes and can help you with a few of these tax reduction strategies. Okay, now the next country, it's probably one of the most misunderstood banking hubs out there, thanks in large part to Hollywood and mass media completely bending who should and shouldn't bank here. But despite this, the banks in this country can offer some of the most interesting tax reduction and wealth building strategies available anywhere. And I'm talking about Monaco. Now, we have people contact us because they're thinking about getting residency in Monaco, and they want to open a bank account. Well, the government requires applicants to deposit 500,000 euros. But in our experience, private banks here want to see at least 2 million euros to get started. And while that might seem steep, banking in Monaco can result in some of the most interesting tax and wealth building strategies out there, which we're about to cover. But first, we still have 2 more countries to get through. And country number 4 is a lower deposit option for anyone that feels like $1 million is too high to start with. Now, I recently had a meeting with a senior banker from this country. He requires about $100,000 to open an account, but his average clients deposit between $500,000 and $1 million. I told him I think that's high, because most banks in this country aren't able to offer the same level of service as premier or private banks in places like Singapore, the UAE, the Channel Islands, the US, or even Switzerland. But there are 2 times when these sorts of deposits can make sense here. First, when you want to access certain tax reduction strategies at lower deposits, say between $100,000 and $250,000. And second, when your citizenship or residency doesn't unlock the other countries on this list. Now, the country that I'm talking about is Panama. And bank selection is extremely important in Panama, not just in terms of successful opening, but also in terms of protecting your money. But if you choose the right Panamanian bank, which we can help you do, then you can unlock a few of these strategies with lower deposits than all of the other countries that we've talked about so far. Okay, I have one more country before I break down the 7 strategies you might be able to use to reduce your taxes through offshore banks. And this last country might surprise you because it gets a lot of hate from the international community. Basically, everyone else tells you to avoid banking here, but we think they're wrong. In fact, we think that this is one of the most overlooked options when it comes to international banking. And that's because foreign non-residents can open accounts here with reputable banks with reasonable deposits 100% remotely, usually with between $25,000 and $250,000. Now, the country that I'm talking about, it's the United States. And what's interesting is that US banks can offer tax advantage solutions to both US and non-US residents, with some exceptions. Basically, you'll struggle to unlock certain structured products or tax deferrals, but a few of the other options are still very attractive. Now, again, before we look at these strategies, you should talk to an advisor before you try anything for yourself, because there are a lot of nuances, especially when dealing with cross-border banking and investing. All right, so strategy number 1. Now, I have mentioned this strategy in past videos because it's incredibly simple, powerful, and surprisingly underused. And the trigger that we're tackling with this strategy is capital gains tax. Basically, the taxes you have to pay when you sell an asset based on the difference between the price you paid and the price you sell at. So your gain. Now, the solution here is really simple. You just never sell the asset. Basically, if you don't sell, there's no tax to pay. And that's why strategy number 1 is using offshore banks to unlock tax-free liquidity. Depending on where you live, you might know this by different names: Lombard loans, asset-backed lending, or securities-backed financing. And like I said, this is a really easy strategy to wrap your head around. You open an account at a private or offshore bank. You deposit liquid assets, think cash, stocks, ETFs, or even gold. And in return, the bank offers you a loan, using those assets as collateral. Since you're not selling your assets, there's no taxable event, no capital gains tax, no income tax. But you still get instant access to liquidity. And it's usually at low single-digit interest rates with favorable loan-to-value ratios depending on the assets you're using. But in most cases, you can unlock between 75 to 95% of the total value. So instead of selling stock and triggering a tax bill, you could borrow against it and use that cash for whatever you want. Now, you do need to factor in interest costs, margin calls, and the risk of over-leveraging, and you need to be aware of anti-avoidance laws, because in some cases, how you use the loan could have tax consequences. But when used correctly, this is one of the easiest and fastest ways to unlock money from your bank while reducing taxes. Okay, now let's say you don't want to leverage your assets, and instead you just want a bank to help you build assets tax-free, or at least close to it. Well, that's exactly what we're going to be talking about in strategy number 2. And while not all banks are keen to hand out money to foreign non-residents, if you know which banks to use, how to qualify, and which assets to buy, you'll find that a lot of offshore and private banks are ready to give you money to build a portfolio. And if you do it right, you don't need any locally sourced income, you don't even need a local credit score, and you can end up paying very little tax. So what I'm talking about is using offshore banks to build tax-friendly assets. And while there are a number of ways to do this, the easiest example here is real estate. So let's say you want to buy a property in one of the most desirable real estate markets on earth. Think Miami, south of France, Zurich, London, etc., etc. We work with banks that help foreign clients buy real estate in all of these places. And in many cases, clients can qualify for a mortgage based on the projected income from the property. Basically, it works like this. Let's say you find an amazing villa in the south of France. You go to a bank and say, I want to buy this place. The bank then issues you a mortgage. The property generates rental income. That income services the mortgage. And in many jurisdictions, both depreciation and mortgage interest will reduce your taxable rental income. So you're acquiring a high quality property in one of the world's most desirable locations, using the bank's money, while having it paid off through income that is then offset by the mortgage interest. Now, the property does need to be properly depreciated, and local tax rules do need to be aligned for you to capture all the benefits. Plus, there's a lot that goes into owning and managing real estate abroad. But if this strategy aligns with your goals, and if you have the right banking relationships to support it, you can even refinance your villa after the mortgage is nearly paid down, extract equity tax efficiently, and then reinvest, start the cycle all over again. Of course, you need to understand local property taxes, reporting obligations, and inheritance rules before diving into international real estate. And like all of the strategies we're going to discuss, talk to a professional advisor before you think about using them. Okay, let's jump into strategy number 3. And this might be the easiest strategy that we're going to cover, but it's rarely talked about in offshore banking, even though it's one of the most widely used by major institutional investors and banks. But the key point here is that you don't need to be an institution to make this work. It's just as effective for individuals, and it's all about where your investments are booked, not where you live, not where your company is registered, or where you bank, but where your assets sit on paper. Now, what I'm talking about is using offshore banking in booking centers. You see, certain jurisdictions, like Singapore, Luxembourg, and Ireland, have extensive tax treaty networks, favorable withholding tax rates, and efficient fund structures that dramatically reduce the taxes you pay on dividends, interest, and capital gains. So if you book your investments in these jurisdictions, you can unlock lower taxes, sometimes cutting your tax burden down by 50% or more, just by choosing the right place to hold your investments. For example, let's say you're not a US person and you live in a country without a US tax treaty. If you invest directly in US stocks, you'd face a 30% withholding tax on dividends. But if you buy an Irish domiciled US ETF, like those traded on the London Stock Exchange, the fund itself typically benefits from Ireland's tax treaty with the US, reducing the withholding tax to 15%. Or maybe you're investing in global bonds or ETFs. Well, by booking those positions through Luxembourg, you can often access fund structures that reinvest the earnings instead of distributing them. So depending on your country's tax rules, you may be able to defer taxes until you sell, if you ever choose to. Now, none of this happens automatically. You need to work with a bank that actually gives you access to these booking centers and understands the layers to your profile, meaning your country of citizenship, country of residence, your desired investment exposure, and the tax implications for all of these and other considerations. That's how you can get the best results, both in terms of investment returns, but also in terms of tax savings. And not surprisingly, the banks that can do all this, they tend to be sophisticated private banks in jurisdictions that are familiar with international clients, like the 5 countries that I've already covered in this video. And the next strategy number 4, it really hammers this home. But before we cover strategy 4, if you're getting anything from this video, make sure you hit the subscribe button. We have videos coming up that are going to help you unlock even more value out of your banking relationships. Okay, now strategy number 4. This one builds on the idea of booking centers, but we're specifically talking about double tax treaties or DTTs. These are basically agreements between 2 countries that determine how cross-border income is taxed, who gets what. And the right offshore bank operating in the right jurisdiction can help you structure your accounts and investments in a way that takes full advantage of these treaties. But this isn't just about investments. Private banks and the right offshore banks can help you navigate these complexities when it comes to interest income, royalties, capital gains, and even pension distributions. It just depends on the countries involved, the treaty terms, and how the income is classified. So what we're talking about is using banks that leverage double tax treaties. And offshore banks that specialize in this space, especially those in traditional banking hubs like Switzerland, can help you structure your investments and income through eligible treaty jurisdictions, and then guide you on how to go ahead and claim those benefits. Now, in some cases, they'll even offer domiciled investment wrappers that are specifically built to take advantage of these treaties. Now, this isn't something your local robo-advisor is going to be able to offer you, so you'll need a bank that understands international tax law, has treaty access, and most importantly, knows how to help you execute the right paperwork and disclosures to unlock these benefits. Because treaties must apply between your country of tax residence and the country where the fund is domiciled. And without treaty access or reporting, you might end up getting taxed as if you own it personally on a look-through basis. But when this is done properly, using double tax treaties through offshore banks can create significant long-term savings, especially for cross-border investors, business owners, and international families. Okay. Strategy number 5, and frankly, I'm always shocked by how few people know about this strategy because it's available in one of the most popular offshore banking hubs in the world, Singapore. And in this strategy, I'm specifically talking to business owners because when done correctly, this strategy can deliver a company registered in one of the most reputable jurisdictions, Singapore, with extremely low taxes. If, and this is key, you use offshore banks. So what I'm talking about is combining offshore banking with remittance-based tax systems. Basically, it all comes down to where your company is registered, managed, and where it banks. And more specifically, whether you're operating in a country with a territorial tax system. So again, Singapore is an example of this because Singapore has a territorial tax regime, meaning it generally only taxes income that's sourced in Singapore or foreign income that is brought into Singapore, also known as remitted income. And that's why I'm including this strategy in this video, because it only works if your Singapore company has an offshore bank account outside of Singapore. and that income qualifies as foreign sourced. Basically, this structure can result in a very low effective tax rate, sometimes even close to zero, as long as the income is both foreign sourced and not remitted. Though any active management or control from Singapore may trigger taxes here. And Singapore still taxes local sourced income, and regulators, they do pay close attention to where your company is managed and controlled. So obviously, before you set up a Singapore entity, make sure to get advice from a tax professional who understands both Singapore law and your home country's tax rules, because how this works can vary based on where you live. Okay, I have 2 more strategies for you. But just as a quick reminder, if you want us to tell you which countries you qualify to bank in so you can start to explore these strategies for yourself, just click the link in the description and we'll get back to you within 24 hours. Okay, strategy number 6. Now, this one is a twist on the first strategy that we covered. Basically, where you're borrowing against stock, cash, gold, etc. So it's also pretty easy to understand. You're borrowing from the bank and not selling an underlying asset. And as a result, you're not triggering any capital gains tax. But like I said, this one has a twist. Instead of borrowing against financial assets, we're talking about using offshore banks that lend against luxury assets. Think antique or exotic cars, fine art, rare wines or spirits, high-value jewelry or watches, and even vintage musical instruments. There's many other items that could be on this list as well. Now, this isn't a mainstream service. Most banks aren't going to be offering this, but certain offshore and private banks, especially those that work with ultra-high net worth clients, have dedicated lending desks for these specific assets. Now, here's why this is so powerful. Instead of selling your rare asset and triggering capital gains tax, you can borrow against its value, often at low interest rates, depending on the asset class and market liquidity. So you continue owning your Picasso, you avoid the tax trigger, and you unlock liquidity that you can use however you want. These lending programs are usually available through banks in traditional private banking hubs like Switzerland, Monaco, and even in the US. Of course, valuation, storage, insurance, and authentication all come into play here, and the underwriting is more nuanced than what you'd see with traditional securities-based lending. But if you're sitting on a significant luxury collection and you're looking for a tax-efficient way to unlock some liquidity through offshore and private banks, this could be one of the best tax strategies for you to look into. And that brings us to our final strategy, strategy number 7. But you should also know that at the end of this video, I'm going to be revealing a country where almost anyone can open offshore bank accounts and start accessing these strategies for themselves. All right, now this strategy is the sort of thing that offshore and private banks love to offer. Basically, if you use this strategy, it means you're investing through the bank. But importantly, it also means you're using products that are not only designed to grow your wealth, but to do so in the most tax efficient way possible. And there are a few different examples of this. I'm going to share 2 with you right now. But generally speaking, what we're talking about is using offshore banks that offer tax advantaged products. And the first example of this are principal protected notes. These are structured products that let you participate in the upside, like equities or commodities, but protect the principal from the downside. But where it gets really interesting is in the structure, because they can be tailored to control when and how returns are realized. So basically, you can defer tax, shift gains to a more favorable country, or time income in a way that aligns with your broader tax strategy. And the second example is something called dual currency investments. These are short-term structured deposits where you can get a higher yield by taking some FX exposure, typically between 2 currencies like USD and Euro or Singapore and Aussie dollar. Basically, you earn attractive returns if the exchange rate stays within a set band, and if not, you may receive your payout in the other currency. This approach can also offer deferred taxable gains depending on how it's booked and your country's rules. Now, these aren't beginner products. You'll need the right banking relationships, proper structuring, and tax professionals to guide you through the fine print. But if you qualify and you're serious about global tax optimization, these kinds of products can open up efficient ways to generate and preserve wealth. But here's the crazy thing. The 7 strategies that we just covered are only a few of the tax strategies that offshore and private banks can help you use to reduce the amount of taxes you pay, 100% legally. But in order to access these strategies, you need to have the right banking relationships in countries where these strategies are available and understood. So, watch this video over here, where I tell you how almost anyone can open accounts in one of the best countries for tax optimization. And I even tell you the 3 steps to follow to successfully open an account for yourself.